In the FM exam, 2 marks can be the difference between a pass and a reset. Today, I'm going to show you exactly how those 2 marks are won and lost. Hello and welcome to the FM mock debrief. I'm Rashad Hussain, your expert tutor for financial management. In this session, we'll break down 6 carefully selected Section A objective questions, each worth 2 marks, covering the key areas of the FM syllabus. The kind of question that looks simple but trap a lot of students. Let's get started. Now, here we have the first question, and this question covers the topic of cost of capital, including the areas of beta asset, beta equity, that is the areas of the ungeared beta and geared beta. Now, let's have a look at the requirement here. The requirement here is to what is the risk adjusted cost of equity and how using CAPM. What is the CAPM formula? The CAPM formula is KE is equal to RF plus beta into RM minus RF. What beta is this? This is beta equity. Now, in order to use beta equity of the existing company, three conditions are supposed to be fulfilled. What are the three conditions? The new business that we start, the new venture that we start should be relatively small. The new business compared to our existing one should be relatively small. Second condition is that the new business should have the same debt equity proportion. It should have the same financial risk. That is the same financial risk. And the new business should be in the same industry, the same nature of business, that it should have the same business risk. Here in this question, when you go through the question, you can find out we are entering into a completely new line of activity. That is, if you look at the condition number one, it is relatively small. Okay, could be okay. Same financial risk could be okay, but definitely the third one, it is not same business risk. Why it is not same business risk? Because if you go through the question here, we are entering into a completely new line of activity, which means we will need the assistance of getting the ungeared beta from the industry that we are going to enter, the new line of business. We have a company here in the new line of business, which is Harrow Company. Of the Harrow Company, they have given us the beta equity of that company, which is stated as the 1.5. The existing beta equity of the Arulia could not be used. Why? We are entering into a new line of activity. We cannot take this 1.3, but our starting point is going to be this 1.5 of the Harrow company, from which we will find out the beta asset. And as per Modigliani Miller assumption, the beta asset reflects only business risk. It does not reflect financial risk. Hence, beta asset is assumed to be same across the industry. So, beta asset of Harrow company is going to be the same for the Arulia, the new line of activity it is entering. And hence, with that, we should be able to calculate the CAPM. You could probably pause the video over here, try solving it yourself, and then watch the rest. Now, the beta asset is equal to beta equity into value of equity divided by value of equity plus value of debt into 1 minus tax. And here it is specified in the question to ignore tax, which means it becomes much easier. I don't require this 1 minus t. And for the value of equity, the equity and the debt value, it is written that the debt by debt plus equity is 35. So debt divided by debt plus equity is 35, means equity divided by equity plus debt should be the other half of it. It should be 65. So here I could write it like this. What is it? E beta equity is 1.5 into 65 divided by 100, which will give me the beta asset as 1.5 into 65 divided by 100, will give me 0.975. Based on Modigliani's Miller's assumption, Arulia has would have the same beta set because beta set is going to remain same within the industry, so that beta set is going to be 0.975. And now calculating beta equity to be substituted over here, the beta equity formula is beta asset into value of equity plus value of debt divided by value of equity. It is very clearly written in the question that is an all equity finance company. An all equity finance company, the equity is same, the debt becoming zero, we can see that the beta equity will be equal to the beta asset. So what happens over here? Here we can see that this very same 0.95 could be substituted over here in order to calculate the K. So you doing the rest of the calculation, KE is equal to the RF, which is 4 percentage, 0.04, 0.04 plus 0.975 into, and how much is the market risk premium, which is 5.05 minus 0.04 is wrong. Why is it wrong? Please note market risk premium is not RM. It is RM minus RF. So here the one of the most frequently made mistake. You do not have to reduce 0.04. Why it is already reduced market. The word premium you are supposed to realize it is RM minus RF. So once we calculate it, what do we get over here? Which is 0.975 into 0.05 plus zero point zero 0.04 will give me 0.08875. If I round it off to one decimal, it will be 8.9 percentage, and that tends to be the second option, which is 8.9 percentage. So this was a very good level question where we've used the cost of capital calculation. We've applied the CAPM and we've clubbed together the knowledge of beta equity and beta asset. The second question here is on the topic of agency relationship, the relationship between that of the management and the shareholders. The management is supposed to run the company in the best interest of the shareholders. Management is supposed to run the business in order to increase the shareholders' wealth. So, when managers don't run the business in the best interest of the shareholders, they try to do it for their own benefit. We have a problem called agency problem. So, here it is asking what is it? An illustration of the principal agent problem. So this has got something to do where the managers work for the shareholders, and when they don't work for the benefit of the shareholders, we have agency problem. Suppliers cutting their cost by using cheaper materials to keep their prices low. This has got nothing to do with between the management and the shareholder. Okay. The I'm not reading the second, going to the third one. Shareholder group disagree over dividend policy. So this is definitely dividend policy is proposed by the management, but this has got nothing to state that they're not working in the best interest of the shareholders. Stock market exerting pressure on companies to achieve short-term profit. This is not something that is exerted by the managers. Again, this is not a case of between the manager and the shareholders. But whereas the second option, managers avoid debt finance. Why? Because they want to lower interest. Why they want to lower interest? They want to avoid the need for careful cash management. So whenever they go for more debt, what happens? The greatest benefit of debt is that when the debt increase, the WACC reduces. Debt is considered to be cheaper, it is tax savings, and hence the WACC reduces. And whenever the WACC reduces, the value of the company increases. So, increasing debt as far as possible is necessary benefit, and it benefits the shareholder. So, here the managers are avoiding that. Why? They want to make it more comfortable for them. So, they are working for their interest, not for the interest of the shareholders. Hence, the point number two is the answer for this principal agent problem. Now, this question is on the topic investment appraisal, the most important area of the syllabus. where we've got to find out the cost of each year, and that cost of each year, the effective cost of each year, is not just done by finding the total cost divided by the number of years. That is absolutely wrong. There are many students who add up all the cost divided by the number of years. No, that is not how it is done. We've got a tool for it, and the tool is called as the EAC, equivalent annual cost. And the formula of equivalent annual cost is NPV of cost of one replacement cycle divided by the annuity factor of that years. So here, I would want you to pause the question at this point, try solving it yourself, and then get back to watch the answer. Now, here in this question, if the machine was bought and replaced every 4 years in perpetuity, what are the cost and details that are given here to find order to find out present value? Year zero, there is what is it? The machine cost 225,000, 225,000 year zero, and it has a life useful life 4 years, at the end of which the estimated resale value, that is a fourth year resale value, is going to be 15,300, which is positive. And it's also written that the present value of total running cost over the next 4 years is going to be negative 55 567. And it's written that the cost of capital is 10 percentage, so take 10 percentage here, one, and 10 percentage for 4 years, 1 divided by 1.1 will give me 6.683 and 0.683. Discounted cash flow, people multiply it, find out the present value. No, this is wrong. Why is this wrong? Why is this wrong? Because watch very carefully the thing that is highlighted. What is given here is the present value. It's already discounted. Present value already discounted. You do not have to discount it again. So that is one of the mistake that is done by many candidates in exam. So whatever cash flow here that is given, this cash flow is already the present value. I only have to total it. So if I total this up, 225, 555, 25,000 will give me 265, 260, 265,267. And my numerator will be 265,267. The 10 percentage annuity factor for 4 years from the annuity factor table will give me 3.17. Substituting 3.17 divided by 3.17 will give you the answer as 83,680.44, taking it to the nearest dollar, so that's going to be 83,680. So the cost of each year, the equivalent annual cost will turn out to be, that is the total present value divided by the annuity factor, gives me how much? 83,680. The requirement of this question over here is to calculate the new EPS of the company. New EPS after what? There is issue of share and the bank loan is redeemed. The existing EPS, the formula for EPS, earnings per share, is the earnings attributable to the ordinary shareholders, EAOS, earnings attributable to ordinary shareholders divided by the number of shares. The existing EPS before the issue of the share and before the bank loan is redeemed, which is not asked in the question. What is that existing? It is 35 million. This is assumed to be the EAS earnings attributable to ordinary shareholders and 75 million. So that's going to be 35 divided by 75 will give me how much? Will give me $0.467 per share. Now this is not what is asked. This is pre-issue of shares. Now, after issue of shares, how much fund is raised through issue of shares? 25 million shares at 1.2 will give me $30 million is raised, and this 30 million is raised in order to repay existing bank loan. That means I'll be able to save interest of how much? 30 million into 5 percentage will give me 30 into 5 percentage will give me, I can say, 1.5 million. But when I used to pay that interest, I had tax savings on it. Tax savings, what was the tax savings? The tax expense at that point of time, I was able to save that up at what? 25 percentage. So 1.5 into 25 percentage will give me, what is it? 0.375. So my actual cost will tend to be, after the tax saving impact, my savings would be, what is it? 1.125. Now calculating the EPS. So we have 35 plus 1.125 divided by 75. 35 plus 1.125 if divided by 75 will give me 0.525, which is wrong. Why? This 25 million share is not considered. So 35 plus 1.125 divided by 75 plus 25 would give me the answer as 0.361 per share, and it tends to be the third option. The third option is the right option, and this is after the issue of the share. Not only the share is issued, but the bank loan is redeemed. Because the bank loan is redeemed, we are able to save interest on it, but we are going to lose its tax savings impact. So thereby, from 1.5 million, we reduce 25 percentage tax savings that we used to get previously. So it gives me a total interest savings of 1.125, which I'm supposed to add it to the 35 million, assuming it to be, there is no preference shares, and dividing it by the old number of shares, which is 75, plus the new number of shares, which is 25, and that gives me 0.361 per share. Now this question is on the topic called value of money. Value of money known by three E's. What are the three E's of value of money? One is economy, efficiency, and effectiveness. What is economy? Economy is getting the input. We buy something at very reasonable price. So it's getting the input at the lowest possible cost. And efficiency is about the productiveness, or it is about the relationship between input and output. We want to get maximum output for what goes in. And effectiveness is the extent to which, the declared objective is achieved, we achieve the goal. Or it also speaks about the, what is it, the quality of the output, the goal that we have achieved. Now there are four options here, and the examiner is asking us to identify best reflect the principle of value of money. So let's have a look at the various four options here. Procuring goods and services the most economical cost. This is nothing but economy. It speaks about economy. It speaks about getting the input at the lowest cost. Launching creative promotional activities to boost brand image. This has got nothing to do with value of money. This is speaking about marketing activity rather. Increasing profit distribution to the shareholders is about the chapter called dividend policy. It is on the topic called dividend policy. Optimizing the use of available resources. So, using the input properly so as to get the output. And this is the, what is it, efficiency. So number one and four speaks about value of money. The option tends to be the last one and four. So this is as far as the concept of value of money is concerned. As far as section A, mock debrief is concerned, that's all for now. Wishing you all the best for your upcoming exams. This is your FM expert tutor, Rashad Hussain, signing off. Thank you.